Previously, we spoke about various avenues that one could consider investing their savings into. In this video, we shall zoom our focus to only one asset class, equities. Equities as an asset has attracted investors for years. Various reasons have contributed to this. Let's understand a few. Equities provide the potential for capital appreciation. There are stocks whose prices have risen significantly over the years, such as from 2 digits to even 4 digits. These stocks have generated mammoth returns for investors who had the patience to hold them for long periods. Besides capital appreciation, equities provide the potential to earn periodic income in the form of dividends. Some companies are known to pay dividends regularly. Investors looking to generate income from equities tend to invest in stocks known for paying dividends. While these two are the key reasons attracting investors to equities, there are more reasons. Let's briefly talk about them. Equities are liquid instruments that can be purchased and sold instantaneously at the prevailing market price. Now, contrast this to an asset class such as real estate, in which transactions might take days or weeks to complete, possibly at a price that is even different from the market price. Also, unlike certain assets such as real estate, you do not necessarily need a significant sum of money to invest in equities. You can even invest a few thousand rupees and increase your investments as your income and savings grow. Because of technological advancements, publicly available information such as company financials and news are now easily accessible to even retail investors. It helps them make informed decisions. Because of such factors, equities have become one of the most preferred asset classes among investors today. Participation in equity markets has risen noticeably. It is evidenced by government data that shows the number of Demat account holders in India has more than doubled in the last 3 years, from around 3.5 crores to 7.5 crores. What is a Demat account? To keep things simple in this video, think of a Demat account like a passbook that banks provide to savings account holders. A bank passbook keeps a record of all your banking transactions. Similarly, a Demat account records all your share market transactions online. Before starting your stock market journey, you must have a Demat account. If not, you need to open one through your stockbroker. If you have never traded or invested in stock markets, do not worry. It's never late to start your stock market journey. Here is an interesting point. Just 5% of India's population invests in the stock market. So, if you haven't yet started, you're not late. By gradually starting as you gain knowledge about stock markets, you will be among the minority 5% of people who invest in stocks in India. Risk and reward. To understand the risk and reward aspect in stock investing, let's look at a couple of charts. This chart shows the historical annual returns of BSE Sensex, a widely tracked stock market index that gives a general sense of how the stock markets in India are performing. From 1981 to 2021, Sensex has given a positive annual return on 31 occasions. The average yearly gain has stood at nearly 20% during these 4 decades. If that doesn't sound interesting, look at this chart, which shows how Rs 10,000 invested in Sensex back in 1980 would have fared over the years. See that by the end of 2021, it would have grown to Rs 40 lakhs. Now that's quite some return. As we can see from these charts, stock markets can be a rewarding journey. However, as the saying goes, the grass is always greener on the other side. What I mean to say by this is that investing in stocks is not a risk-free affair. Unlike in a bank fixed deposit, where your invested money is entirely safe, you can lose some or most of your invested capital in the stock markets if things do not go as planned and you don't have proper strategies to curtail your losses. To understand this aspect, look at this chart, which shows the performance of Sensex in the year 2020. While Sensex ended 2020 with a gain, notice the decline between February and March. During these 2 months, Sensex lost its value by nearly 40%. Now that's a significant decline. If someone had invested Rs 1 lakh in buying stocks at the start of 2020, that 1 lakh rupees would have stood at around 60,000 rupees by the end of March 2020. That's an enormous erosion right there. While drops of this magnitude in such a short period are relatively rare, you must be aware that they can happen. Hence, when investing in stocks, focus not only on rewards but also on risks. You can go a long way in your stock market journey by managing risks efficiently. That's all for now. We hope to see you in the following video where we shall continue discussing the basics of stock markets.